Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today we're going to go through the EIA. We're going to break it up into our normal three segments of EIA overview, the going in a little bit deeper into refined products, and then looking at exports. So just getting right into it, we can see that crude had a nice draw of about 10.6 million barrels, and it was really driven based on PADD 3, which you can see here at 10.46 million coming out of storage. And you have to consider, well, why did that happen? And again, like these are numbers that can always kind of move around a little bit, which is why we always talk about seasonality. We talk about where's the trend going on a 4-week average, and just what are things, how are things going to get impacted over time? So here you can see that, crude oil production was relatively flat. Again, we see most of these shut-ins coming fully back online. But again, PADD 3 was really driven by Hanna. So what did we have? We had imports, which were down 795,000 barrels a day, which again, some of these boats that were sitting on dock had to go pushed back into the Gulf of Mexico, just in case there was a storm surge. We want to preserve the docks. Exports were up 218,000 barrels a day, which you want to load it as fast as you can and get it off the dock, just to again protecting that infrastructure. And we did have runs up 389,000 barrels, which was mostly driven based on PADD 3, which we'll talk about in a minute. But we also had this adjustment number, which the EIA uses, which was down about 814,000 barrels a day, which is why we always talk about trend. We talk about where things are going, because this number can get smoothed out, if you will. So what it really means is that production was either lower, imports were either lower, exports were higher. It was probably honestly a mix of all three, just given how Hanna was impacting, who prepared for what, which is why this is something that we expect to see some adjustment back to norms next week, or I should say this week, in terms of some of these imports increasing and some of these exports dropping, this week into next. And that's why, when we look at just, again, things on a seasonality level, we always focus on including the SPR. And here you can see we finally dipped back below where we were in 2016. And typically on a trend level, we normally have draws this time of year, again, just based on increased demand driven by summer, which we've obviously had a shakeup because of COVID, which we'll touch on in a little bit. And here you can see, just looking at PADD 3. So the reason why we kind of hone in on PADD 3 storage is just because of the exports, the imports, Texas being a huge producer, the Gulf of Mexico being a huge producer. This is a very important area. And you can see we're still well above where we were in 2016, but we're trending lower. This trend will reverse to a certain percent, just as you get a little bit more of a normal activity, given some of the adjustments that we had from the hurricane/tropical storm Hanna, and then now how things are adjusting a little bit. Now, just to kind of dig in, okay, well, how did it really impact us? And this is where we talk about those imports. So imports really, even though the total was down 796,000 barrels a day, it was really PADD 3. PADD 3 saw the biggest decline of 656,000, which again is something that we expect to reverse this week into next. But the other nice thing was we did get an increase in refinery utilization rates. Now, it may sound nice because you're going to pull more crude through the system, but it also resulted in a build in refined products, which is why we currently have, crude pricing flat at about 41.25, but we have refined product margin crack spreads just getting decimated with some of these prices, specifically in gasoline and distillate, which we'll talk about in a minute. And this is why some of these runs, we have that confidence range. We think we're going to average that 75%, but we think we're going to start to see some of that rollback, especially as we had some hiccups within PADD 3 with some power outages. So some of these numbers will come down a little bit, and it won't reverse completely. But again, we're starting to see some of these reductions, especially as we start preparing for September and what is the beginning of shoulder season. Now the case is implied demand. These are things that we talk about going up, going down. Implied demand for gasoline was up about 3.3%. depending on, whose numbers you use, Gas Buddy was up about 1%. So again, it's this is a calculated number. So we have to respect that. And we have to think that it was good to see an increase, but we still have that confidence range of about 8.5 million through the remainder of summer. And then distillate is just going to ebb and flow, which we'll dig in a little bit further as we go through the refined product deep dive. But going back to the Gulf Coast oil floating storage, we saw the increase. The increase was really coming from some new cargoes entering the Gulf of Mexico, as you had cargoes going from oil in transit to oil in storage, and we also had some of those boats kicking back out, which are now considered floating storage again. So this is a number that will drop, but again, it's not going to drop the same way because this is just the calculated number as well, where we're trying to count boats, figure out where things are. So this is something to watch, but this is the crude that is going to come back on shore. It will get imported, which will offset some of the draws, specifically in Pad 3. And that's why we look at Pad 3 imports, because this is where we're always looking to see, okay, well, what's happening? And you can see we fell below the seasonal low, going back to 2015. And if we go back even further, but, we want to keep things tighter because the market's obviously always changing and evolving. So over the last 5 years, we're back down to the lows. It's something why we're talking about on a timing level. This will adjust, this will increase, which will offset some of the declines that we saw this week. And then we go into that refinery utilization rates, and this is the big piece of the importance of what is going to happen over the next couple of weeks. And here you can see we've kind of plateaued, we've moved up a little bit, and just given where crude prices are, where crack spreads are going, and where they are right now, it's going to be really hard to see these refiners starting to ramp up anymore, given the amount of distillate floating in the market, the gasoline demand kind of plateauing here. It's going to be really difficult to see these guys really rally and try to pull through more crude just because the demand isn't there and prices are getting squeezed, which is squeezing margins, which means these guys have to make money and they're just not making money, which we'll go through in a bit more depth as we go through the refined products. So now that we turn to the refined products, we can start with distillate. Now, distillate kind of came in line. The expectations were for a build of about 500,000 barrels, which is what we saw. The bigger issue is just where are we versus historics. We continue to take out these, previous highs. Now I think we're back to 1982 highs for where we were in December. So now you kind of get an idea of why these numbers are frightening, especially as we're going into shoulder season, because we have to do something with the distillate to kind of clear some of this storage space. And the problem is there's just no takers abroad. We've seen all of these boats that have, whether they've gone to India twice, they've gone to Singapore, then got loaded onto a bigger ship and then moved back to the Middle East. And the problem is Europe is typically where a lot of this distillate ends up. And it's just, we're not seeing the demand in those regions. And the reason why it mostly ends up in Europe is because their refiners aren't really built to create the kind of distillate demand that they have there. So they rely on the floating market, and especially the U.S. market. And we're just not seeing the kind of demand driven by a lot of things, mostly just COVID and the lack of industrial production. And that's why this is going to be a problem as we go forward, especially as refiners have to weigh, well, where am I going to put all of this product? And which is another reason why we talk about refinery run rates really not being able to increase past this point, just given the issues that we see across the board on a refinery, on a storage level. And that's why when we look at demand, we've talked about how distillate specifically here, that distillate demand is going to pretty much hug that 5-year average. We don't see anything that tells us it's going to go through a floor, but at the same time, we don't see anything that's telling us that it's going to explode higher. And it's because we're getting this weight on both sides of the supply-demand picture. We have, obviously the supply remains there, but demand is kind of twofold. So as we shift towards the demand problem that we've talked about, it really originates in rail traffic and shipping. So here you can see the U.S. rail traffic, which is down for this week, down about 15.7% versus 2019. But more importantly, on a year-to-date level, we're down about 16%. And when we turn to the Intermodal Association of North America, they're showing June intermodal down 4.9% versus June. So it means that we're continuing to see less stuff move around, which is just weighing because it's compounding on the real issues within the economy. So then when we look at international containers, what's originating from the international markets and moving through the system, that's down 13.2%. So that means there's less boats moving less stuff, which is going on to less rail, which is just, again, it's a problem with demand. And this is why we continue to talk about China, some of the lies that they're saying on some of their data, and just why the global market struggles because shipping just isn't there. And then when we turn to someone and say, okay, well, this is one indication. Well, let's talk about someone else. Well, we turn to Global Port Tracker, which published their monthly numbers, and they see another decrease in August of 13.3% year over year. Now they're assuming some things start to get a little bit better with 12.3%, only a 12.3% decline as we go into September and October, with hopefully a normalization by November. But again, these are the issues that we face. We're trying to project something forward, but COVID cases continue to rise, which is something we're going to talk about in our economy show. But when we talk about the problems on the rail and on the shipping side, trucking remains an outlier. Trucking continues to see, as we can see here, based on what FreightWaves put out, we achieved a new record in July. So even though we're not seeing the same amount of shipping containers or rail containers, we are seeing more things moved by truck. And it's, again, we have to consider, well, what's happening in the supply chain? The supply chain is seized up. There's choke points in different areas. What can get around some of those choke points? And it's trucking. We still have a lot of spare capacity in terms of the trucking market. So there's just more rigs to move around. And this is something that's beneficial because if you're not moving it by rail, if you're not moving it by barge, if you're not moving it by boat overall, you are moving it by truck. So again, this is why we talk about how there's that demand cap, but you also have some of this base where we're seeing some of the support coming from the trucking sector. So now as we go into gasoline, last week we talked about how we saw a big increase in imports coming, and they did show up. And it's something where they're going to continue to show up on the East Coast, but it's going to pare back. So here you saw imports increase about 381,000 barrels a day, mostly into pad 1 of 285,000 barrels. But the bigger issue, just based on where we had, the estimates were for a draw of about 1.2 million barrels in gasoline. Instead, we got a build of 660,000. And this is why we keep talking about these plateaus, because we're starting to see some of this kind of normalization. And here you can see the seasonality chart. Typically we trend lower as more people consume gasoline through the summer months. And here we had that little adjustment, really driven based on lower demand, but also those imports that helped kind of offset some of these draws. But again, the draws just aren't really making up. And this is going to be a problem as we go into the shoulder season and demand falls off as we come out of summer driving. And when we talk about summer driving, who doesn't love our Google mobility data that we tried to look at and really get smart on? Because here, as we go forward and start, again, projecting forward, Gas Buddy says that based on their demand figures, U.S. gasoline demand for Monday and Tuesday is down 1.5% for Monday over Monday, and down 6%. So right now, so far this week, we're down about 2.3% week over week, which if you consider the fact that the EIA reported an increase of 3.3%. Now we're seeing a decrease of 2.3%. Again, this is why we keep talking about these ebbs and flows. And here you can see some of the mobility. What are people doing? And we see retail and recreation. Again, these are things that have kind of flatlined, which is why when we go to the economy show, we're going to talk about where are people driving, where are people going, and we can kind of see that the activity levels really remain at this cap really as we go forward. And when we talk about the cap, I always think it's good to visualize it. And here you can see that gasoline demand, again, calculated number, so you have to kind of weigh the different pieces. And here you had the peak, you came down a little bit. This is where we believe we're going to kind of go back and forth, and we're going to stay within this range as we go through summer. And when we talk about the summer driving season, just to be clear, it technically ends Labor Day. So these are the kind of things that we're going to look at as we head into the Labor Day weekend, which we think that there's going to be an overall weight as we go forward, which is going to keep us capped here. Now look at jet fuel. The jet fuel is one that we talked about. We believe that we saw a peak and that we were going to continue to see jet fuel demand kind of fall off. But again, not fall off to the levels that we saw, but normalize lower as we do have more flights coming back. We have about the next slide will go through kind of how many in total, and it's something that we're gonna see some of these flights coming back. But again, it's not going to be at the same initial level perceived. Marriott has the CEO has made comments on how every market is facing its own hurdle, whether it's shutdowns or COVID spikes or trouble getting employees. These are things that again are impacting on a broad level, which is just keeping people local. Because if you're living locally, oh, this place is open, that place is closed, I can head to this county versus this county. So those people, it just makes people comfortable, but at the same time, it keeps people off planes because you could be heading into a state that you may not know as well. And we're seeing that reflected in that TSA data. We continue to talk how we're going to kind of sit between the 600,000 to 750,000. And we've seen that, we've really kind of plateaued. We believe that we're going to hold this level as we go through the remainder of the summer. And we think it's something that will drop off as we go into what is really flu season, because, well, is it the flu? Is it COVID? Is it a cold? People, I think, are going to want to avoid some of those questions. And you can see as we have versus 2019, we're still down about 73% year over year, which is just something that we don't think we're going to close that gap this year or even next year. But when we look at the global summary of flight departures, you can see that we have seen some recoveries. The recoveries have been in China, they've been in other parts of Japan. But we have to consider what's happening in those countries as well. China is facing a significant amount of flooding. They also have their own increase in COVID cases. So China, we believe, is going to start to slow down some of these flights. Japan is facing another outbreak. Australia is facing another outbreak. And you're starting to see, again, just as you think you're on top of it, all of a sudden this new outbreak happens. And the US, you can see on a week over week change, we had a little bit of a decline. We should see those increase over as we start going through August. But again, this is why we think we're in this plateau, this right here, because even though you get an increase, then you get a decrease. And again, it's just, we're not seeing a sustainable rally in some of these flights, just given the uncertainties in the market. And again, that bleeds over into a lot of other places. Open Table is one where we continue to talk about this flat line. Here we remain 60% year over year on seated diners on a global level. And it's just, we're not seeing that sustainable increase over time. And as we go into the economy show, we're going to show how, what does that mean for jobs? What does that mean for temporary closures or permanent closures? Because this is going to be a big problem for jobs as we go forward, which again, jobs equals people driving more, feeling better, spending more discretionary, and just, consuming gasoline and jet fuel. And here, when we talk about the regional breakdown, globally, again, 60%, but we've seen Australia fall back off as we've had an increase in some of these COVID cases, but Germany remains the bright spot. So Germany had a little bit of an increase in COVID, but again, it was more regional in terms of, where it was. So that's something where we think we're going to kind of maintain some of the strength. The bigger issue is the U.S., which we remain between, let's call it 55 and 65%, depending on the day, whether it's weekend, weekday. And these are the issues that are going to remain because, again, people just aren't as active. People aren't tourisms in these new locations, so they don't have to go eat. And how do you save money? You save money by cooking more at home, which is something that we're also seeing if we go back to the mobility data. Grocery stores, people are still going to the grocery store more than before. And it's, again, showing up here as people spend less to conserve capital, which, again, conserves gasoline. Now that we have gone through some of these different pieces of the EIA in terms of just, where do we sit overall, where do we sit on refined products, now we have to turn to the export market. And here is a place where we talked about how exports were going to ebb and flow. kind of hold a specific level kind of closer to the bottom, just as global demand remains continues to struggle. Distillate is the one that we're going to see the kind of the biggest ebbs and flows, just because there's an increasing amount of competition coming from not only the Middle East but also Asia, coming into our historical markets of Europe and Latin America. Gasoline is another one. Latin America continues to struggle under the weight of COVID, which is just limiting the amount people can actually move around. So distillate and gasoline, those are where we're going to see some of the biggest kind of hiccups as we go through the remainder of the year. And crude exports. We talked about going above 3 million this week. We just assumed that some of this was going to get pulled forward as guys rushed to get stuff off the docks ahead of Hannah. We had an increase of 218,000 barrels a day at about 3.2. This will pare back. We'll see this fall back below 3 million, just because we're going to have an increase in imports just to kind of offset some of those timing delays that were caused by the hurricane. But again, these are things that we have to be cognizant about, because where are we going to be over time? And that's why when we turn to gasoline first, we talked about seeing the decline back to the 5-year average. And there's really no reason to see a sustainable rally above or below, just given based on, especially as we look at pricing, as gasoline does have an expiration date. Gasoline does go bad. So you have to continue to adjust that flow. Given the shelf life can be 6 months or greater, depending on how you do it, where it's stored, what the quality is. But it's something to be cognizant about as we look towards, a continued slowdown from COVID, people not driving the same amount on a global level. So we're going to have to get some of this stuff off our coast just to keep kind of moving that gasoline through the tanks. So this is something to watch. But again, as we go higher, then we'll start to see things adjust. So the 5-year average, we're comfortable in kind of saying that that's going to be the norm as we go through the remainder of specifically driving season, but as we really go into the end of the year. Now, distillate is one where, again, it's going to be price discounts. How much can we compete with what's happening in the market? We viewed that we had that spike. We viewed that we were going to pull back closer to the 5-year average. And again, that's something that we think is going to remain relatively consistent as we go forward, especially as we start to see builds across the globe, specifically in Singapore, and some of the builds in Fujairah. That leads us into the global inventories. And, we had another nice, small little decline as we look at US, Japan, and Fujairah. But again, the US, this was driven some by oil, where Fujairah had a little bit of an increase in distillates. Japan had an increase in distillates, a decline in oil, and the US again had that increase in distillates and that decline in oil. So the question is, okay, well, if I'm declining in oil but I'm increasing in distillates, that's why we look at these as one unit, because this is where we're going to see, okay, well, how much crude is being consumed, how much diesel is being consumed to move stuff around the world. And we're seeing Singapore is showing some more builds. China is just dumping product into the market just because they're running out of storage space. And we're just not seeing China and South Korea increase their consumption to the levels that we were hoping to kind of take some of this glut out of the market, which is why we continue to see these boats just essentially do dances in the middle of the ocean, because there's no place to put this distillate, which is going to be a big overarching problem as we go forward. Because if I can't place my distillate, then that means I can't run more crude through my system to make more distillate. And this is where we continue to see this cycle where refinery run rates globally just won't be able to get back to a solid footing to see oil demand really recover to, I think, where estimates, say they are. So, thanks again for watching. We're gonna follow up with our econ show, and then a nice little OPEC plus and geopolitical backdrop. And we're going to continue to go through and kind of cover things that we think are going to be important to driving not only oil demand, but how does the market look on a macro level. And then on Friday, we get to wrap up with our favorite show, the Primary Vision Frac Spread Count. So thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.